Welcome, everyone, to Name Confidential Live.
Hey guys, welcome back to another week. Just wrapped up a nice breather on the markets this week after some obviously intense rally. I'm joined this week by JC Parets of Trend Labs. A lot of you guys probably know JC and follow him. And the biggest question I want to put in front of you today, JC, is the name exposure index this week came out 80.87. So active managers as a group were net long, but not fully invested. And there's this pinnacle moment when you came and spoke at one of our conferences in Scottsdale a couple of years ago. So it was early in 2023. You kind of surveyed the crowd and said, "Hey, who thinks we're going to be in this in a new bull market?" And like no one was raising their hand. And you still use that to kind of poke fun sometimes at us and the name index. So now it's 80.87. We just came off a huge period of volatility. There's a lot going on in the markets. And so the question is are we in a new bull market from here? And are active managers once again on the wrong side, or are we positioned in the right direction here?
No, I appreciate the invite. This is great. I've been, following the work that you guys do for, I don't remember not following it, right? Like, I mean, for me, this is part of the data that we input into our systems to help us make the best decisions possible. And it's not about like, poking fun at, you guys or individual investors or portfolio managers that Barron's polls or, fund manager surveys that Bank of America does. And it's not, has nothing to do with that specifically. It's more about understanding positioning. And that's what Trend Labs is really all about. That's what we're trying to identify, where the market is most mispositioned. A lot of people know me, historically through All-Star Charts, great research company, does great work for hedge funds and, mutual funds, financial advisors, traders, individuals, like really across the gambit, right? And that's great. And that continues to be an amazing research company. I'm still chairman of All-Star Charts. Trend Labs, on the other hand, is really more specific to me. And, at this point, I'm a much different person than I was when I started All-Star Charts. I'm 43 now. All-Star Charts was a blog when I was in my 20s, living in New York City. I've got a 4-year-old daughter. I've got twin 2-year-old boys. I have I have responsibilities as, the leader of the household, and so I think very differently. I have very different objectives than I did when I was in my 20s. I have very different objectives than some of our hedge fund clients or, institutional clients that are doing very different things. I am looking for different strategies that are uncorrelated with one another to truly achieve that diversification, right? To lower overall portfolio volatility and increase the acceleration of the compounding of those returns. And I know mathematically I can do that by having a variety of different strategies. That's real diversification. I'm not sacrificing forward returns in order to have diversification. Actually, it's quite the opposite, right? So that's what Trend Labs is all about, and finding the divergences between the narrative of the market and what the market is actually doing, right? Your organization does a great job of capturing a particular segment of active investment managers, and that's great. That's helpful, but it's only one segment. There's a lot of different segments, individuals, hedge fund managers, we look at, the options market. Like there's so much data out there. And I think that the real value is in aggregating all of it together. So that's my, sort of my my prequel. The How we use it is really important to understand. You know, Particularly you guys, active investment managers tend to be bullish for long periods of time in bull markets. Shocker, right? Like that makes sense. And the data supports that. Individual investors through like an AAII, for example, that's going to be much more erratic. It's going to be much more volatile, as one would imagine individual investors are very emotional. So that also makes sense, right? But I think the key thing is that, you know, the market could stay bullish for a long time in bull markets. I am more interested when there is extremes in pessimism. That is the more actionable side of the equation for me when it comes to sentiment. And when you and when the story you're describing was in the spring of 23, right? Spring of
Yeah.
23, and everybody, we were coming off the bear market of 21, 22 that ended in the summer of 22, and things really were getting better from there. So by the time spring of 23 came in, the fact that there were still so many bears, to me supported the fact that leg higher had legs, essentially, right? And sure enough, not only did we finish 23 with a 24% return for the S&P, put up another 20 spot the following year, right? So that from that extreme pessimism across markets, you saw a tremendous gain. And where we are today, while active investment managers might be somewhere in the middle, there's not really an extreme. I think we are in fact coming off some really historic extremes, which I think can be a tailwind moving forward for markets, for stocks.
Yeah, so your thesis there is essentially if things are getting better, but people are still off sides or out of the game, at some point they got to come back in, right?
Dude, the consumer sentiment Michigan just came out, second lowest print ever. Barron's big money poll, these are hundreds of professional portfolio managers, most bearish ever. And this data goes back to the 90s. So think about these data sets that we're seeing that, the individual investors by AAII, over half of that survey was bearish equities over the next 6 months, over half for 11 consecutive weeks. That has never happened ever. And that goes back to the 1980s. So think about it. In all of these readings, you're seeing data that supports the case to be made that there is more fear today, or a month ago, 6 weeks ago, we're coming off those levels of fear than at the bottom of COVID, or when we were staring into the abyss during the great financial crisis, or dot-com bubble lows in 02, 03, when we thought this was over forever, right? They thought, the point is, today they are more upset and bearish on all of these counts than in any of those moments, which is unbelievable to think. And, I think that supports the case for stocks continuing higher. This is still a bull market. And, historically, it's more beneficial during bull markets to own stocks than it is to not own them.
It's a fair analysis at the end. So has there ever been a period where like the sentiment ends up being right after being at an extreme like that? Like, hey, it wasn't enough time for it to play out. And it turns out, 3 or 6 months later, after all the effects went through the economy, all the sentiment was right. Or does the sentiment shift and play out, and it might play out in the economy, but it doesn't play out in the prices of stocks?
Yeah, you see it. You saw it in 08, good example. In the spring of 08, that sentiment got pretty extreme, and then markets bounced pretty dramatically, and then ultimately rolled over again, made new lows. So I think it comes down to time horizon, right? Is this the bottom? I mean, it's certainly a bottom, right? Is it the bottom? I guess we'll see, as the data comes forward. But
sure.
Yeah, I mean, I think that you want to be in the direction of the underlying trend. And I think it's really important to zoom out and put things in perspective. And it's like, how can the stock market go higher? It's like, well, which stock market? Because Europe did nothing for 20 years and is just now getting going. So when you're talking about something that's unsustainable, which part is it that's unsustainable? What it is the massive U.S. outperformance. That's what's unsustainable. Because when you study bull markets throughout history, the U.S. is an underperformer in a lot of them, right? So the fact that the U.S. outperformed for 15 years like it did over everything else, that is the outlier. So I think we're just this reversion that you're seeing this year into all these foreign markets in Europe and Asia and Latin America. I think that rotation continues. Africa making new multi-year highs. Are you kidding me? Africa? Right? So that's the market that we're in. And doesn't mean that the United States is going to go down in that environment. It just means that there's a lot of other things working, not just U.S. mega cap tech.
Yeah. How do you square that with when you look at international? Like sometimes international gets put into just two buckets, right? Developed and emerging markets. And one of the things that you call out is like, hey, Israel is way different than Africa, which is way different than Argentina. How do you navigate that landscape rather than just saying, well, I'm in US or I'm in everything else?
It's a great point. And I think that you need to hand select where you want to be and where you don't want to be. I think that this is one of those situations where it's hard to screw it up. There's a lot of options that'll probably do well, like you've seen. So there's that part, like there's the, maybe it's worth owning some baskets, like that's okay. But you're spot on. Like there's going to be spots that are going to be better than others, no question. And that's really all part of the rotation. And it's understanding, what are the drivers of some of these markets, like. In Germany, for example, you got a ton of industrials and a ton of financials. And so what are the best performing stocks in America or otherwise? Industrials and financials. So should it be surprising that Germany's making new all-time highs every day? Probably not, right? So that makes sense. And then, understanding that in certain countries, they just do different things. In Canada, for example, there's no healthcare stocks in Canada. And so you've got a lot more energy and materials and industrials than you do in Canada, and financials, right? And those areas have been doing really well. They don't have tech stocks in Canada, very few, almost none, right? What's the one that they have? They have the Shopify, right? That's like their one tech stock, right? And so they got a lot, it's just different economy. And so the stock market's making new all-time highs. They're not loaded up with these tech stocks and semiconductors that were correcting, right? So they held up a lot better. Same thing as Africa. Do they have mega cap social media companies right there? No, they very different in Africa. In Chile, they don't have mobile phone, conglomerates. They dig holes in the ground and look for rocks.
It's I think is that like, so is that more a play on hard assets, or is that more a play on currency?
Chile,
or
Peru, you get natural resources, copper and all those things, and gold and all that stuff. And, Brazil, you can have energy, like Latin America, you're just going to have they're different drivers than you're going to get somewhere else.
I do find it fascinating that some people talk about the S&P 500 or the American market, and there's been this huge skew to tech, but what no one really calls out or oftentimes talks about is it like the skew towards tech, but also are we missing the point that energy is such a small component now, right? Like XLE is an animal of its own the last several years, and it's a tiny little piece of the market at this point, right? It's just not the same player it once was, but it's also what's driving, according to what you're saying here, it's what's driving some of these other markets in a pretty major way, the same theme.
Yeah, not so much energy yet, although I think energy is probably, likelihood that it's next, because, when you see gold moving first, that tends to be it tends to be a leader. Then you get copper, you got that. Energy's next in line, right? Like if past cycles have taught us anything, is that would be the next logical step higher. To your point, 3% energy in the S&P 500. Dow's got 2% energy. They kicked out ExxonMobil right before it tripled. Shocker, right? Speaking of sentiment, right? They kick out ExxonMobil, so now all they got left is Chevron. So 2% energy. The NASDAQ has 0%, 0.5% energy in the NASDAQ 100. So there's just no exposure there for Americans. So you have to go elsewhere, while some countries it's just a lot more energy, of course, right? You can't have any less than you have in America.
Yeah. You're obviously very much a technicals guy. Do you have any fundamental thesis or macro view on what is driving any of this? Or
no, definitely not.
Trust the price.
It's really just the positioning that I'm more interested in.
Okay.
I'm not more interested in macro forces. I'm interested in, skating to where the puck is going. Like I'm Cuban. Cubans don't know anything about hockey, but or ice. Right. But my understanding is that that's what you want to do, right? You want to skate to where the puck is going. Do I have that right?
Yeah. Yeah. That's the saying. Yeah.
Yeah. You guys have ice in Utah, right? You guys know.
Not
right?
the part I live, but yeah. Otherwise.
Sure.
Yeah.
You're much close. Right. So in Cuba, they don't have that. But my understanding is that that's how it works, right? So that's what we're looking to do, right? I was at the Masters the other day, which was unbelievable, by the way. Wow. The Masters.
I've heard great things.
I'm like a sports fan, so I thought I knew the Masters was a big deal, and it is, but I got there and I was like, oh wow, okay.
You know what I've heard about the Masters? I've heard the Masters is so flawless. It's a sight to behold, the garbage cans there.
It is something else, man. I've been to Super Bowls and World Series and all kinds of stuff. Wow. Anyway, so I'm going with a guy who invited me, who has been there every year since he was 8. So this guy knows Augusta inside and out. He knows every trick in the book. And so, I got the greatest tour ever. So anyway, we're sitting on one green when all the top of the leaderboard were teeing off on Saturday, right? When Rory birdied 1, eagled 2, birdied 3, right? Remember that on Saturday?
Yeah.
And then ended up winning the Grand Slam, like whatever. Unbelievable. So anyway, we're on 1 green. And then my guy, he's a financial advisor, Stephen Weitzel. He's the man. And he's like, look, guy, you see all those idiots over there standing by the tee box? They can't even see anybody teeing off on that tee box. There's so many people there. And we were in the front row at 1 green. And he's like, look at those guys. Those are the guys that are selling. Those are the guys that are buying puts with the VIX at 60, right? These guys are way too late, right? So then he's like, watch, they're all going to come to us. Sure enough, they all come. We're right in the front row. So they couldn't see anything there. Now they're chasing Rory. They can't see anything. We're sitting right on 1 green, front row, watching Rory sink a putt for birdie. Like, we were where the people were gonna be, right? We were where the people weren't, because we saw extremes on the tee box and we knew they were coming. And he's a financial advisor, knows how I think. So he put it in those terms. And I was like, man, this is great.
So yeah. So the idea is you saw them up at the tee box and you said, pretty crowded. I know where they're heading next.
We didn't even go there. We didn't even go. We got a sandwich.
I'll just beat him to the next spot.
Dude, this guy had it down packed, man. It was unbelievable. What an experience.
That's good. So like, where do you see the puck? Based on all the sentiment you're looking at, where do you see the puck going right now?
I think you're spot on with the lack of exposure and energy. I think there's extremes and lack of ownership. A lot of short interest in oil and gas stocks and explorers and producers, multi-year highs in short interest in all those areas. So I like that from a thematic squeeze perspective. I like looking for relative strength. So there are areas in energy and oil and gas that are working. I look at like Comstock, for example, CRK, but there's others in that space that are already making new highs and doing well. So when I see a space that's vulnerable for a squeeze and some of the names there are already working, like, I think about those as future leaders potentially, right?
Okay. What about in the metal space? Like I've heard more, obviously not a ton, and nothing out of the retail kind of space, like, none of the friends and families and the high school buddies and former Army buddies reaching out, but like the gold mine, like gold mines and silver mining and that kind of stuff.
Yeah, at this point, we were early on this gold trade. The gold was already making new all-time highs priced in every currency for years and years, right? Like, we were already seeing that. It was really just the Swiss franc and the dollar, and gold was still not breaking out price in those currencies. And then Swissy went, gold broke out versus Swissy. So in other words, Swissy broke down price in gold, and then the dollar was the last one left. And then ultimately the dollar broke down relative to gold. That's the breakout that you saw. But it was really just the last domino to fall. Interesting seeing the gold mining stocks like picking up now. What I'm really interested is the platinum and the palladium. That to me is an area that I think, really just getting going. Really just getting going now. So if you're asking me about the precious metals and what's happening, look at like Sibanye, SBSW. That is like the pure play platinum palladium sort of situation. So if you equally weight a palladium and platinum chart, right? So 50-50, palladium, platinum, and overlay Sibanye, they look identical. So this one, I believe, is South African.
It trades in South Africa, or the mines are
no.
Africa?
It trades around. No, it trades on the NASDAQ. It trades SB. Okay. Yeah, it's an ADR. Just regular stock. Like, it's like the CCJ of uranium. Like, this is the, you know what I'm saying? Like, yeah. It's
okay.
like that.
I'll check that out.
Like, there's some like little other platinum stocks, but you're not going to mess around with them unless you're a real junkie. Kind of like those little uranium stocks. Like, you can mess around with them if you're a real junkie, but CCJ is the one. It's kind of like that.
Yeah. So what about platinum and palladium is making you think that that's a play to be had in, where the puck's going?
Man, I'm looking for volatility contraction, right? Because from volatility contraction comes expansion, right? Yeah. And so, man, these things were just consolidating so tight, like a move was coming. And then if you're looking at gold and silver moving higher, and platinum's got to make a decision here, which way you think it's going to go, right? Is it going to break down while all the cousins are breaking out? Like, that doesn't make any sense. So, looking for a breakout there, and it's happening.
And so are you a bigger fan of getting in a trade early prior to the volatility squeeze, or waiting for it to begin happening, looking for a confirmation and catching like a breakout?
Yeah, it's funny. We talk about this a lot, and we've been fine tuning over the years, and we actually just built a scan. Believe it or not, speaking of Canada, it was a Canadian guy in Toronto who built it for us, and it really filters to be able to get right the first day of the volatility squeeze. We get alerted. So you got that crazy contraction, and we're looking
Yeah.
for the volatility compression is what we call it, right? And we're looking for the most compressed. And then we have like a crossover that is like day one of the volatility squeeze, and then we get alerted.
That's all right. So
Pretty awesome.
so
That's
catch
brand new.
it
It's
for
like a
the
new toy.
breakout. Yeah,
New
no
toy.
need to be early, I guess, if you got something that good.
Right.
So
I mean, it's just math. Like you can set it like, right? You just
yeah.
keep tweaking at it, keep tweaking at it. And then, because what you just said is like what we talk about. Like your question was a great question that's come up in conversation again and again and again. And so we've been fine tuning, finding a
Yeah.
solution for exactly what you just described.
Well, it's like the old sayings, right? It's like there's not much difference between being early and being wrong, right? And so if you're just
Yeah.
expecting like volatility is compressing, I'm here,
Right.
but it takes a year to compress. You
Correct.
start to look pretty
Yes.
wrong.
Yes.
So
That's exactly right.
and
But
capital's
you get it.
precious,
You get it.
So let's talk like really quick. I mean, we only got a couple minutes left. I think like the granddaddy of the conversation that everyone always wants to know about is the old S&P 500, the broad US markets. It's like, where do we go from here? Because there's some big gaps that not big, but there's some gaps that we made on the way up. So people are speculating we got to go back and fill those gaps, but you have a little bit of a breather come off and market looks like it caught some bid. Some of the indexes are hanging on to some really, I think, like key support levels. And things don't look as bad as I think the sentiment that you were describing earlier is yelling. So just like, I don't know if you have an opinion on it or not, but just
Yeah, I mean,
curious on your
listen, I
thoughts.
think 5,600 is the big one. I think that's the big one. 500 on the Qs, that's a big one. 5,600 on S&Ps, 500 on the Qs. Like those are some levels that we probably want to hang on to. There's a lot of memory there. The Dow's kind of flirting a little bit. That short term is the big one, and that short term, those are the big levels. We're above that, all business as usual. We're buying stocks, right? Bigger picture zooming out, it's really the 21, 22 highs, right? The Dow highs at the end of 21, S&P, NASDAQ, like at the turn, like those highs
Yeah.
that were retested last month. So did the S&P Technology Index. So did the S&P Communications Index. Same exact chart. They all just kissed those former highs and ripped higher. So bigger picture, those are the levels. Short term, 5,600 on the S&Ps, 500 on the Qs-ish, got to hold those.
So you think is like what I'm hearing is it's possible to retest the lows, but if those lows don't break, we're still in a bull market, and
yeah, and I think that the probability
of
of retesting last month lows are not high.
Yeah, that's fair. I think it seems to become more and more evident. I was shocked. I really was a little bit shocked this morning when Trump was like, "Hey, next week we're going to do 50% tariffs on EU," and the market sold off like 50 basis points today. Is it? It opened up lower, but I mean, like you would, if that would have happened a month ago, right? The market would have been on 4 or 5%, and
yeah, but also like think about it. Like rates are high. What's hilarious is that rates stopped going down when the Federal Reserve started lowering rates, right?
Yeah.
Which is hilarious. So that's always fun. And so, rates are up and somebody goes like, yo, Trump daddy, rates are a little high. We got to do something about this. And then Trump goes, haha, watch this. And then he just sends out a tweet and then boom, rates come slamming down, bonds rip, right? Commercial hedgers are super long bonds right now. So they're on point. Trump's like, yeah, you want rates to stop going up? Watch this. That's what happened.
I actually, I posted this morning on X. I was like, so all the people that were talking about, oh, hey, we know where the Trump put is now. It's not actually in the stock market. It's 5% on the 30-year. That's where the Trump put is. And so everyone is expecting, like, when the 30-year hits 5, like, I think a lot of people were expecting him to come out and say something that was going to be bullish for the market again. And it's like, yeah, that's where the put is, but bond yields moving doesn't necessarily always mean the stock market goes up for you. So it was an interesting dynamic, I suppose, on the Trump put happening this
Yeah,
morning.
who knows what happened? I kid, but like, am I kidding? I don't know. I might be onto something there, but
Yeah, I think there's a lot of talk around the Trump put at 5. I don't know why. I mean, mechanically, I don't know why. It seems to be there. But a put or a Fed put or a Trump put in the bond market is, I think, like, just wildly different than an expectation of a Trump or a Fed put in the equity markets, like people have been used to. And that dynamic doesn't play out how a lot of people might expect.
yeah, I mean, listen, I think that I think there's a big chance. I think there's a big chance that this squeeze continues. I remember in 2016 when Trump was elected the first time, I was living in California, a lot of pessimism, oh my God, the market stocks are going to crash and volatility is going to spike. It was the opposite. You had one of the greatest years in the history of the stock market, by some means the least volatile year in the history of stock market, depending on how you measure it. But it was actually the exact opposite of what sentiment was. And, this year when Trump was being elected, what the market doesn't like is uncertainty. And with Trump, like him or hate him, like, at least you know what you're getting. You've seen it before. There's less uncertainty this time around. So the sentiment actually wasn't that bad until the terrorists really started, and that really sent sentiment really crashing down. It was never great, but that really sent it down. And so, I think the Trump squeeze 2.0 is like a little bit later start. While Trump squeeze 1.0 started immediately and didn't look back, this one started a little later, really took sentiment a little longer to get extreme, and now here we go.
So careful not owning U.S. stocks is what it sounds like, but
I mean, I think stocks in general,
we'll
I think
see.
international can outperform in that environment. I think there's certain, also growth, like a lot of pessimism in like small cap growth. ARK, for example, highest short interest ever. Small cap Russell 2000 ETF, highest short interest in 52 weeks. Like, so a lot of pessimism out there in like speculative growth areas. So that's an area that we're continuing to look.
Yeah, I guess keep your eye out for the volatility compression in that.
You like that?
That would rocket fuel.
Yeah.
Well, as I've heard you say before, what do you say? Trust God, trust the bond market, and maybe trust price.
No, you trust dogs, right?
Dogs.
Trust the dogs and the bond market.
Dogs in the bond market. Okay.
Yeah.
I had it wrong. Dogs. Yeah, I'll leave the dogs to you. I don't trust dogs, man. But dogs in the bond market and maybe price. I've heard you say, though, and maybe price.
Right. Yeah, right. Of course. The price of the bond market.
The price of the bond. The price of the bonds. That's it. Well, yeah, I don't know.
In bonds, we trust.
In bonds, we trust. I'm going to get a shirt with that. So cool. Well, hey, I appreciate you hopping on. You're one busy dude, JC. You've got a lot going on. I always enjoy the content you're putting out, a lot of smart stuff. I always find it like just a wealth of value in that. And I've been fascinated ever since I heard you speak in Scottsdale a couple years back.
I'm glad I went.
So yeah, we'll have you out again sometime, hopefully.
I'd love that.
And give you some more material to use for a couple more years to go.
Get me at extremes.
Okay. Well, hey, appreciate it. And we'll see you around, JC.
All right, my man. See ya.